You probably don't remember September 2019. No market crash, no global panic, no emergency presidential speech. And yet, for 48 hours, the US financial system quietly stopped trusting itself. This wasn't 2008, this wasn't COVID, this was a strong economy, low unemployment, rising stock market, stable growth. And still, something cracked. Let's rewind. On September 16, 2019, something strange happened in the US repo market. If you don't know what that is, good, because most people don't. The repo market is where banks, hedge funds, and financial institutions borrow money overnight. Short-term loans. Ultra boring, ultra safe. Or at least that's what everyone thought. Here's how it works. Institution A needs cash. Institution B has cash. Institution A gives treasury bonds as collateral. They agree to reverse the trade the next day. Simple, safe, routine. Except on that morning, rates spiked violently. The normal repo rate was around 2%. Within hours, it shot up to nearly 10%. Overnight money suddenly cost 5 times more. That's not normal, that's panic pricing. And panic pricing only happens when trust disappears. Here's the scary part. No major crisis was happening. No Lehman collapse, no housing crash, no pandemic. Just a regular Tuesday. So what went wrong? Liquidity vanished. Banks suddenly didn't want to lend to each other. And when banks don't trust banks, that's when systems freeze. Within hours, the Federal Reserve had to step in. Not publicly dramatic, no sirens, but behind the scenes, they injected $53 billion in emergency liquidity. The next day, more, then more. Eventually, the Fed was pumping hundreds of billions into short-term funding markets. Again, this was not a recession. This was during good times. Now, ask yourself something. If the system needed emergency life support during calm weather, what happens during a storm? Here's what most people missed. This wasn't about bad mortgages. It wasn't about toxic assets. It was about collateral velocity. The modern financial system runs on reusable collateral. Treasury bonds aren't just safe assets, they're fuel. The same treasury security can be used multiple times in multiple transactions. It gets pledged, repledged, rehypothecated, like financial dominoes stacked on top of each other. And when one participant hesitates, the entire chain tightens. Suddenly, everyone wants cash at the same time. This is how liquidity crises start, not with explosions, with hesitation. Now zoom out. After 2008, regulators tightened traditional banks. Higher capital requirements, stress tests, liquidity buffers. Sounds safe, right? But risk doesn't disappear. It migrates. It moved into what's called shadow banking. Money market funds, private credit funds, hedge funds, structured vehicles. Institutions that behave like banks, but aren't regulated like banks. By 2019, this parallel system had grown massive. Trillions in short-term funding. Built on confidence, built on collateral reuse, built on the assumption that someone will always lend tomorrow. And for 48 hours, they almost didn't. Now here's where it connects to you. You might think, I don't trade repos, why should I care? Because your entire financial world depends on liquidity. Your bank depends on short-term funding markets. Your pension fund depends on stable credit markets. Your stock portfolio depends on functioning leverage. Modern markets don't collapse slowly, they seize. And when they seize, central banks intervene. In 2019, the Fed restarted balance sheet expansion quietly. Many analysts now believe that episode was an early warning sign, a stress fracture. Then, 6 months later, COVID hit and liquidity truly evaporated. This time, the Fed didn't inject billions, they injected trillions. What September 2019 showed us is something uncomfortable. The system is more fragile than it appears, not because it's evil, not because it's corrupt, but because it's optimized for efficiency. And efficiency reduces buffers. Banks hold less idle cash. Institutions rely on continuous funding. Everything works until confidence drops slightly. And here's the brutal truth. Confidence is psychological. It's not mathematical. You can have strong balance sheets, but if counterparties hesitate for 24 hours, stress multiplies. This is why systemic risk isn't about one bad actor. It's about interconnected promises. Modern finance is a web of short-term obligations. Roll them forward daily. Trust that tomorrow looks like today, and hope liquidity never disappears simultaneously. September 2019 proved it can. Without headlines, without riots, without retail investors even noticing, the Fed stabilized it. Markets moved on, but structural fragility didn't disappear. It expanded. Since then, government debt increased, corporate leverage increased, private credit exploded, shadow banking grew larger, and central banks have already used their biggest weapon once. So, here's the real question. If the system required emergency intervention during a stable economy, how resilient is it now? This isn't fear-mongering, it's incentive analysis. Financial systems naturally stretch towards maximum leverage because leverage increases returns and competition forces institutions to optimize. But optimization reduces slack, and slack is what saves systems under stress. The 2019 repo spike was a warning shot. Most people ignored it because markets recovered, stocks kept rising, life continued. But stability isn't the absence of collapse, it's the presence of resilience. And resilience is expensive, so institutions minimize it until they can't. Here's what smart observers focus on now: liquidity conditions, credit spreads, funding stress, collateral quality. Because crises don't start with headlines, they start with tightening, subtle signals, rates drifting upward, volume thinning, confidence softening. Then suddenly intervention, and the cycle repeats. So, no, the banking system didn't collapse in 2019, but it almost choked for 48 hours during sunshine, which raises a deeper issue. Are regulators ahead of the system or permanently reacting to the last failure? Because financial innovation always moves faster than regulation, always. Shadow banking isn't illegal, it's adaptive, and adaptation under competition leads to complexity. Complex systems aren't evil because they're interconnected. They're fragile because they're interconnected and highly leveraged. Which means the next disruption probably won't look like 2008. It won't rhyme perfectly. It will emerge in plumbing, in funding, in places most retail investors never examine. And by the time headlines catch up, liquidity will already be gone. The question isn't if the system survives. It probably will. The question is who absorbs the volatility when it strains. Because when funding freezes, asset prices move violently, and positioning matters more than prediction. So, remember September 2019, not as a crisis, but as a preview, a moment when trust flickered, and the entire machine required emergency oxygen. Not during a recession, not during war, just during an ordinary week. That tells you everything about how modern finance really works. This is dark capital, and the system is stronger than ever and more fragile than ever. Both are true. The only question is, which one matters first?